Hey, what's going on, guys? So in this video, I want to show you my favorite way to do a hedge LP setup. There's a couple ways to do it if you are trying to hedge with perps. And in this video, I will show you using the Drippy simulation tool. And first, we got to start from looking at the chart, right? If we are implementing this hedge setup with something like ETH to USDC, doing this on this pair is probably a bit safer than if you're trying to hedge like crypto to crypto pools, or you're trying to hedge like a lower cap altcoins that could move up pretty aggressively, and the liquidity might be thinner on these different Perps platform, right? So let's dive right into it. Looking at the chart, if we are trying to do a hedge LP right now, in my opinion, this is actually not the best setup because by hedging, you're reducing the potential upside to protect the downside, right? There's always going to be a trade-off when you are implementing any strategy. And again, none of this is meant to be financial advice. I'm just sharing what have helped me and my personal way of doing a hedge setup. And if I want to do a hedge though, and I want a tighter range because maybe I care more about fees, then a lot of times we have to do a partial hedge because of the way concentrated liquidity behaves, right? So let's go to this Drippy tool here. And let's say I want to put in 100K just to make the numbers more simple. And the price currently is trading at 19.59. And if I want to bump that up a little bit just to make the numbers more round and more easy to think about, I could start at $2,000 here for my entry. And I want to make sure that I reset the simulation price. And depending on how aggressive you want to be, you could set the ranges here, right? And in general, I don't recommend going too tight because you're going to spend too much time managing your positions. And a lot of times, if you have a smaller portfolio, just doing a tight range just doesn't make sense at all. And you're just spending too much time managing a small portfolio. And a lot of times, setting a tighter range does not mean that your performance is going to be better because a lot of times the prices do trend pretty aggressively. But let's just say you're expecting a rough scenario like the previous bear market where maybe the price is kind of just bouncing in this zone here, right? But I probably won't go that tight. Let's just say I want to do like $1,000 to $3,000. That is a pretty comfortable range, right? So 1,000 to 3,000. And based on the chart, having this wide of a range would let us be in range for a few months at a time and sometimes like a year or two at a time if prices don't actually rip back up to the upside, right? But this is not a big deal if you only use a portion of your portfolio to do a hedge setup. If you already hold some ETH on the side and you don't miss the potential upside, right? So right away, we could see this composition here. We're going to be putting in about 38% of ETH and 61% of USDC. And if I'm not happy with this ratio, I could always adjust the exposure. And usually the more ETH you put into this pool by having a bullish range, then the heavier the short could be when you first start this position. But let's just say I want to run with this for now. I could add a short hedge here. And what I want to put in this input is maybe like half of this ETH. I could start off with that and see how that would impact our equity curve, right? So this is the equity curve if you include the LP as well as whatever you put into the short. So let's just say I want to put 10 ETH worth of short. What I can do is simulate if price actually go to the max upper range here. And you can see with this heavy of a short, I'm going to be losing about 1% of my total capital, about 1,300 something dollars. That's not a great thing if you're trying to do a partial hedge. What I personally like to do is I want to basically lose no money if prices go up, right? And I personally prefer that. Again, it depends on what you prioritize, but I can basically adjust the short amount to be, let's say, 8 ETH, right? And I would be in slight profit here. So this would be fine in this scenario. And then if prices reset, you can see you're going to have zero profit and loss. And if prices do drop to $1,500, if I expect that's where the bottom is going to be, and you can see I would be losing about 8% of my total capital compared to losing 13K here without a hedge, right? So that is a slight improvement by simply having some protection in place, about like 5% less. And this is also really good because if prices do move down, I could decide to rebalance to a bullish range and take on this small loss and buy more asset at a cheaper price. I prefer losing some money on the downside versus like losing a lot of money on the upside. If you do overhedge and you lose a lot of money on the upside, or you're getting stopped out if you are setting a stop loss, then a lot of times you're not going to have a lot of great opportunity to buy assets at a discount, right? So even if I lose some money here, assets are getting cheaper, so I could just buy those assets if I want to and take some losses on my capital. At least my losses are much less than like what the market loss is. Let's say the price moves all the way to $1,000, so a 50% price drop, you could see with the hedge on, it's only losing about 25% in value. So 29K in total and 37K here on this initial LP value here, right? So this percentage terms actually include whatever capital, whatever margin that you put into the short account. So in this example, we are putting about 16K for that 8E short because we are using 1x leverage. And because we are using a tighter range, you could always decide to tighten this up, right? Let's say you want to put 1.5x leverage. You could put the stop loss at 3K as well. And then that is going to pull up the same simulation as if I just move this sim price to this max range here at 3K, right? You could see this is at stop loss, right? And then if I want to take profit at 1500, that's where I would say, okay, maybe I want to switch strategies. I will realize this 8% loss that I showed you guys earlier, right? And again, this percentage terms is taking into account this margin capital. So your total capital is 110K here and total of 8% loss. And again, if prices move all the way down to $1,000 without the hedge, you would be losing this 37K amount here. With the hedge, you are losing a little bit less, right? That's the idea of the partial hedge. And again, the reason why I prefer losing some money on the way down is because I could buy these assets at a cheap price. And chances are the prices are going to kind of bounce up and down, right? So you don't necessarily have to lock in any losses here. And if I do decide to lock in losses, a lot of times I am buying these assets. So if prices bounce back, I could actually gain more capital than what I actually lost on the way down. So that's the idea here with the hedge setup. And there's another way to hedge with a wider range LP. I want to show you guys that as well. So I want to reset this setup here. And I did mention that if we set a bullish range, the more aggressive we could hedge. So let's just say I want to bump the min price to 1500. You can see this will bump our ETH ratio up a little bit. And then maybe I want to set my max price to be at $6,000, right? So this is going to have more of a cap gains. So this equity curve would actually look closer to holding spot ETH, right? Not exactly 100% because you can see if I turn on this HODL value here, my capital is still going to appreciate less than if you were just holding on the side, right? Because of that, we can't hedge one-to-one if we don't want to lose money on the upside. So I could add a hedge here. And because we have more ETH here at 37 ETH, maybe I could go all the way up to 25 ETH. And what I want to simulate is if I want to close my position at 3K, you can see that even though I'm hedging much more than earlier before, I could actually still gain 2% here on this 3K price point that we were simulating earlier. And I could bump that up to 30 even. And you can see I'm losing a little bit of money. So I'm dialing that back down, maybe to 28. That's a comfortable amount, right? And then we could simulate again if price goes to 1500 or 1000, and I could always put it into this stop loss amount here, right? So if I put a stop at 3K and then take profit at 1500, you can see this profit and loss amount here. And compared to earlier, we are losing a little bit less money at $8,207. And let me recreate what we had before on a new window so we could compare. So this is the tighter one from 1,000 to 3,000, right? We only have a short hedge of about 8 ETH. And again, at take profit $1,500, you can see this 9,300 something dollars loss here versus this 8,200 something dollars, right? And maybe you still don't want to take that much losses. What we could also do is bump this max range to, let's say, 100K. That is actually going to switch our equity curve to be really close to a more bullish setup. And let me reset to this $2,000 here. So instead of depositing the min range from 1500 to 6K, we could do, let's say, 1500 to 100K. And then we start at $2,000. You can see that the ETH amount is about 43 ETH at deposit. We are depositing 86% of ETH. So quite a lot of ETH here. And what I can do now is I could bump up the size of my short, right? So let's say I want to do a 35 ETH worth of short. You can see that even at a 3K stop loss here, it's actually still gaining me about 1%, right? And as long as this number is positive and I want to do a partial hedge, I could actually increase the size further, right? Maybe 40 ETH is a little bit too much. So around 38 ETH here. And you can see that this total loss amount dramatically drops to about only 4,000 something dollars. About like a 2 to 3% loss on our total capital if we include this margin here. And if we don't include that, that is about like a 4 to 5% loss here compared to this 9 something percent loss, right? And you can see the main downside is the margin requirement as well as the fees that you're going to be able to generate. So if I want to tighten the margin a little bit, I could increase my leverage to, let's say, 1.5x. It's going to actually move my liquidation price to be here. And I could simply set a stop loss at this $3,000 mark if I want, right? And then what I could also do is if you are setting an LP in VFAT, you're managing your position there, you can actually set an automated exit here on the upper range, right? So in this scenario, we would probably do a 3K upper range exit if I am using VFAT. And again, just using the price range that we would be setting, you could set it all here, right? Basically at 3K, we're going to exit the LP position into USDC, and our short is going to be stopped out for a very slight profit here. And again, the reason why you might want to have this option is to just earn some more stable yield without actually a huge drawdown, right? Your mass drawdown is only about like 4% on your capital. If the funding rates are positive, meaning that the longs are paying the shorts, you will be earning some funding rate. It usually hovers between 5 to 15% depending on the market. And if there's a lot of short, that funding rate could actually flip negative. There's ways to work around that using different platforms like Boros. But basically, you're going to be earning that on this 50K capital here, right? And then this 100K capital is going to be earning this LP yield. And from the top of my head, a wider range like this is probably earning about like 10 to 15% APR if you are in like a wider range pool. If we're comparing both options, then this wider range strategy might not work as well with stuff like ETH to USDC. Maybe it's more suitable for stuff like Hype to USDC, where you're combining an even wider range with a larger short, especially if you are trying to get more funding rate yield. But for this particular setup, if I'm comfortable with the price being between like 1500 to 3000, I would probably go for this LP right here, right? But I do want to also mention with this wider range, it is lower risk. So if price goes all the way to $1,000, so I put this in here into this simulation tab, you can see this first row here as a 50% drawdown. We're only suffering about like 11K worth of losses, right? So 11% on our initial LP capital and about 7% if you include this margin required here. This is a lower drawdown approach because we are using a larger hedge, and that is only possible if you set a more bullish range, because if you set a more bullish range, again, your LP capital is going to appreciate faster. And because your short is static, it's still allowing you to break even at this stop loss mark, right? And there's a lot of flexibility here. For example, I could decrease the size of my short a little bit and maybe move up my stop loss price to be about 3,800. And in this case, I would need to bump up my leverage a little bit so that I have the room to actually get stopped out rather than being liquidated, right? And then you can see exactly how that would impact your capital. For example, now our loss would increase to 18.96K. But then the potential upside is you're going to be able to stay in range for longer until you get stopped out. Because if prices do move to 3K for that previous setup, you will be getting stopped out earlier. And if we go to the tighter range, we have to, again, use a smaller short. And if prices do go all the way to $1,000, Our drawdown is going to be more aggressive at about like 29K. So almost 30% of our initial LP capital and about 25% if you include this margin required here. So it's actually not too bad if you prioritize fee generation and you don't necessarily have to actually do this take profit here. And if you do want to do the stop loss and take profit, you could set that directly on like different perps platform like Hyperliquid. And VFAT also has the option for you to close your position if let's say ETH hits like $1,000 as well, right? You could swap to ETH. That's what you want to pivot to, right? You're buying ETH and then maybe closing out of your short position into USDC. You're taking that capital to buy some ETH. That's a great way to pivot to just holding the asset, or maybe you're rebalancing to a bullish range. But basically, the main upside for a tighter range in this scenario is you're not going to require as much capital to hedge, right? You could always go to 1.5x leverage if your stop loss is at 3K. So we only need about like 11K here to fund our short, and then the rest could be into the LP position. And because the range is tighter, you're going to be earning probably around like 30% for this particular range. I have a pool right now that is pulling about 30% with this exact range. So that is roughly what I would expect. And if price goes all the way to $1,000, we would be losing about 29K. If the price goes to this take profit level, which is set at 1.5K, you're going to be losing less than 10K, right? So in my opinion, the risk and reward is pretty good if you want to run this type of setup. And the range is wide enough for you to not overly manage, or you're not going to get stopped out all the time and you have to re-hedge or whatever. I see the issue with a lot of people trying to do a hedge strategy with the ranges way too tight. They're using like a maybe plus minus 10% range, and then they're throwing on a hedge as well. Maybe they're under hedging, maybe they're over hedging. If prices go to the downside, you run into a lot of problems. If prices go to upside, you run into a lot of problems because now you're not earning yield. That's also another con with this setup. If its price goes to 3K, you're basically holding USDC for this particular position, right? So if you're using this hedge setup, typically you don't want to put your entire portfolio into it unless you don't care about price appreciation at all. You're just here for the cash flow. But in my opinion, that's not really great, because then if prices move up, you're limited to less options, right? Versus using this only as a portion of your portfolio. Maybe if price moves up pretty aggressively, you could still use the USDC, whatever you have from this portfolio, to run another hedge setup, or to simply realize the profit and realize some of the other spot holding or other crypto to crypto pool profits that you have that actually got some capital gains out of it, right? So hopefully that makes sense, and hopefully that was helpful. Again, I don't think it's a great idea to overly hedge or use a hedge strategy with a really tight range. I feel much more comfortable with like a, let's say $2,000 wide range with this strategy versus a strategy that is just too tight and just requires too much management and you're getting stopped out all the time. And in some scenarios, if you are overhedged, let's say you set like a 1 to 2 or 3% loss when you get stopped out with a tight range, a lot of times you're just realizing losses for no reason. I don't really see a reason why you should do that. And the reason why I don't prefer that strategy, because there's always a chance where like the prices could stop you out way before you could earn enough yield to offset the losses that you get stopped out on, right? And when you get stopped out, it's just really tricky to manage too with a tight range, because you have to re-hedge, and it's just very difficult to like kind of manage that re-hedging process, especially if the prices are kind of lingering where you got stopped out on, right? So if you set your stop at, let's say 2,500, you get stopped out at 2,500, prices went to maybe 2,550. Should you really reach short, you can't really do that, right? And then maybe you set another order at 2,500, but then the price dropped to 2,450. Okay, you have another short setup that you just recreated. Then the price went back up to 2,550 again. Then you're closing your position. You're actually incurring a lot of transaction fees. I personally do not prefer that. And again, if I do get stopped out with this particular setup, I would just use the USDC for something else, right? Hope that was helpful. And if you want to sign up for Drippy, check out our website. We should be live pretty soon. We might be live when I actually publish this, and you're going to have access to all of these tools. We're also building the portfolio tracker and pool scanner, but these two are still in development. It probably takes a while. And we're trying to make like a higher quality product so that you guys could get the best risk and reward possible when it comes to yield farming. Thank you once again for watching. And if you have any questions, leave them down below. I'll be happy to answer them. See you on the next video.